Let's be honest, we all thought we found the one FVG that is going to hold and take us straight to our take profit, but it simply doesn't work. In this video, I'm going to show you how to spot the right FVGs, the ones that truly matter, and how I've been successfully trading them for over 5 years now. This exact approach got me interviewed by Funding Pips, which led to countless profit from payouts. If you can watch the video from start to finish, then don't be surprised when you're missing key details on how to implement the strategy yourself. Okay, so straight into the video. Before I explain to you how to trade the FVGs in a very special way, we have to understand what is the fair value gap, or also known as FVG, to begin with. Now, we have 3 candles right in here, and I want you to focus on all of those 3. And I'll mark them out. This is the first, this is the second, and this is the third candle that we are going to look out for. Now, I want you to pay attention to number 1, which is this one, and to number 3, which is this one. Now, as you can see, the low, basically the wick of the candle number 1, if we extend it to the right, is this candle wick touching the third one candle high? As you can see, it's not. That means we have a fair value gap right in here. And here's an example where we do not have an FVG. This is not a fair value gap. So I'm going to mark them out for you again. This is the first, this is the second, and this candle is the third candle that we're going to look at. Now, if we extend from the first candle low all the way to the right, is it hitting the candle high of the third one that we are going to look out for? Yes, it does. So we are not creating a gap. There's no gap right in between this price action right in here. No matter how you draw it, there's no gap. The same applies to bullish fair value gaps as well. As you can see, this is the exact same price action that we have just looked at, but the opposite way. So as you can see, this candle number 1, this candle number 2, and this is candle number 3. If we now take the high of candle number 1 and extend it to the right, is it hitting the candle low of candle number 3? No, it's not. So we're creating a gap, and anything could be traded into here and traded either to the upside or downside. We will get to that very shortly. I also want to demonstrate you a bullish example that this is no FVG that we want to trade, because there is no FVG to begin with. Now again, I'm going to mark it out. This candle number 1, this is the second, and this is the third that we're going to look out for. If we extend the candle high of candle number 1 all the way to the right, you can see not only are we hitting the wick of it, but also the entire body. So there is no gap that is created right in here, resulting in no FVG that we can trade off from. Now, before we get into the great stuff of this video, why do we care about FVGs to begin with? And also, what are the benefits and how can we make money out of them? Because at the end of the day, guys, this is the most important thing about trading. We're trying to make money in this, nothing else. So the reason why FVGs are extremely powerful and important to master as a whole, because most of the time we always trade back into them. Now, I am going to show you a couple of examples. We have already talked about what an FVG is, so we're not going to explain it again. As you can see, we have a fair value gap right in here. Okay, this entire zone that I have marked out is the fair value gap. As you can see, price traded into it and went lower, right? And you can spot another FVG right in here once again. If we extend the lines from left all the way to the right, you can see we traded back into it again, mitigated it, and went lower. My point is here that FVGs most of the time always get hit. There's, of course, exceptions where it's not going to get hit, but most of the time FVGs are a very reliable way to know where price is going to go next. And you can do this over and over again. As you can see, we have another FVG right in here. Now, as you can see, this is 1, this is 2, and this is number 3. And number 3 did not trade a wick to the upside, but that is no problem. That still counts as an FVG. Don't get confused by this. We have another FVG in here, traded into it, and went lower. And here's another very last example of a bearish fair value gap. As you can see, we have another one in here. We traded into it, and what happened next? We traded lower, and this could have been easily traded either to the upside or downside, but we are going to trade a little bit different from the traditional way. So stick to the video. Now guys, you can have the best strategy, the best risk management, and also be a master at psychology, but every professional trader needs a professional journal. That's why I personally use TradeLens. Now if you want a 10% discount, it's the second link in the description. I have also prepared bullish examples so you get it right every single time, no matter if the price is going up or down. If we zoom in once again, you can spot we have another FVG right in here. Price traded into it, got a lot of down candles, a couple of up candles. It hovered around this area a little bit, but then eventually it went higher. Now, once again, if we remove all of the lines so it doesn't get too messy, you can see once again, we have a fair value gap in here, a very small one, but it still counts. We have a smaller one in here. Price traded into it. Of course, it went lower than the FVG, but that is no problem. It still respected it because it went higher and took out this high. This is the most important part that people get wrong. A lot of the times, people say that, okay, it got mitigated with a body closure below the entire FVG that we have drawn out. But that is wrong, guys. As long as it continued to the upside and took out this high, then it was still a valid fair value gap. And we have to note it in order to know where price is going to go next in future examples. Now, and here we have one more. As you can see, we're a fair value gap in here. And now different from the previous fair value gap that we had where price was going up and down. In this case, price only gotten into it with a weak closure and immediately shot up. And that is very typical and totally okay. It doesn't matter. My point is that the FVGs don't have to get filled entirely. That is not my point of it. FVGs only get traded into sometimes barely just 1 pip, right? So even just a little bit like that with a weak closure below it and still go up or down depending on the direction. So guys, don't confuse yourself into thinking that price will hover around in this fair value gap and then only go up. No. And here's a very last example for the bullish fair value gaps. As you can see, we have another one in here. We traded into it and we went higher for the distribution. Guys, and very quick, I had to make countless of mistakes to acquire all of this different knowledge that I'm presenting to you. And this was all before I became a profitable trader. But now I teach other traders on how to avoid the same mistakes that I've gone through. I cannot cover everything in one video, so if you want to learn more, join my mentorship. The link is in the description down below. And what I have just shown you, right? So I have shown you bearish examples and bullish examples. Basically, that is how you determine the entire order flow of the market. Now, how could this be broken down? If you see one FVG being respected, that is already good enough, right? But only if you have a higher time frame high that you're looking out for it to be taken out. However, if you have 2 FVGs in a row being respected like this, so this is the first, this is the second, then you already have confirmed bullish order flow. Same goes for the downside. As you can see, we have one FVG that got respected and we have another one that also got respected. That is already confirming us that the order flow is bearish, okay? So having one is already good, but only if you have higher time frame confirmations, such as an important high, relative equal highs. I teach this in other videos. But in order to say and confirm that the order flow is bearish or bullish for that matter, you need 2 FVGs that had to be respected beforehand. And just in case you have wondered what those little price gaps are, we will also go over them in this video, because they have a very special nature to them. Okay, before I explain to you how I personally trade FVGs, I have to explain to you how most traders trade the FVGs, or also known as fair value gaps. And this is causing them to donate money to the market over and over again. So most traders, they see an FVG right in here, and the first thing that they assume is, okay, we will trade into this FVG, which we did, and then we will trade again to the upside. But that in itself might not be wrong, but come on guys, it all happened to us over and over again that the FVG did not get respected and we just traded lower and lower. Because this is the reality of trading. It happens so many times that people confuse fair value gaps as an entry because we're not in the current direction that we are looking out for. Now, the trader who wanted to trade this to the upside assumed that we are in a uptrend right now. But here's the difference. We as low risk reward traders, we don't want to trade this as an entry. We want to trade it as a take profit. Because you can clearly see this FVG did not get respected. We completely invalidated it and didn't care about it at all. This is not the right time to trade this to the upside. Most of the time it does not work. And here we finally are. I have just explained to you what the wrong way is to trade it, what the traditional ICT idiots are doing, and it is not working. What is the right way to actually trade the FVGs, especially as a low risk reward trader? Now, as you can see, we have a 4-hour time frame right in here. Each candle is representing 4 hours worth of time. So every single candle could be breaking down into 4 one-hour candles. We'll get into that very shortly. But most importantly, as you can see, we have an FVG right in here. We traded into it. And what have I explained to you earlier? FVGs most of the time always get hit. So instead of trying to trade off of this FVG like an idiot and trying to trade it to the upside, we're taking this information and thinking, okay, this kid might take profit. So instead of trying to long it onto the upside, we're trying to short it somewhere above because we know that FVGs get hit, and therefore this is a take profit and not an entry. And as you can see, I've just talked about a 1 hour time frame. Each and every candle is representing 1 hour worth of time. So basically, we are looking into this entire price action, but just zoomed in, more details and more information that we can look at. Now, don't get confused. This entire area, so this blue line and also this blue line, is representing the 4 hour FVG, which we have just talked about. Now, how could have this been traded? Basically, as long as the FVG did not get traded into, you can take a short to the downside. Your stop loss should be way higher than the recent price action in order to ensure that the stop loss will not get hit, because we can't really predict when it's going to go down onto the 4 hour FVG that is represented to your right in here. That's why we have a very low risk to reward. And don't just take my word for it. Go back into the chart. Look for 4 hour and 1 hour FVGs. Most of the time, not all of the times guys, but most of the times the FVGs get traded into. And if you spot an FVG, just zoom into the chart again, just like we have done for the 1 hour chart, and then look for better entries. This is exactly what we did. This is even a very exaggerated example because the entry is basically at the low of this entire price action. When shorting, you want to take the highest price as possible. But even if you catch a very bad entry, it is still okay because we know, as a matter of fact, the FVGs mostly get traded back into. Here we have another example. The time frame doesn't matter because this applies to every single time frame. You just have to zoom in, right? So let's just assume that this is the daily time frame. As you can see, we have a fair value gap right in here. We traded into it and went lower. Now again, most traders would have taken this as an entry, and in this case it actually worked out, because I don't want to discourage traders who are actually doing this, but I want to make sure that you're trading this the right way if you're trying to copy the same results that I have gotten. So again, instead of trading this to the downside, you want to trade it to the upside anywhere in here. And as you can see, we have just zoomed into the chart. If we assume that the last time frame was a daily time frame, this now becomes a 4 hour time frame. As you can see, every candle once again is representing 4 hours worth of price action. We have marked out the FVG already, and as you can see, we trade into it. Now, how could this been traded? Basically, the daily FVG that we have created right in here has been confirmed after this candle closed, right? Before that, we did not have a confirmed FVG. So once again, this candle closed. Now we have a confirmed FVG, and now we actually are looking for higher prices. And you could have literally have taken a trade anywhere in here. But I'm also going to show you an example. And here you once again have a very exaggerated but still valid example. So once again, the entry was not the best, but it doesn't matter because this way of trading has a very high win rate. And in order to be profitable, you have to have a very high win rate because the loss is pretty big. But since you're winning so many times in a row, a loss rarely occurs. And I can't stress enough on this. Instead of trading this to the downside, because most of the time it does not work. Of course, sometimes it does work in this example. I've specifically chosen this example to show that this way of trading works, but it doesn't mean that this is the only way of trading. However, most of the time, this is the safer approach because this is more likely to get hit. And I already know what you're thinking. Let's talk about the elephant in the room. Why is your risk to reward so damn low? Because most of the time, traders are going for a high risk to reward, right? So this is representing their stop loss, and this is representing their take profit. So they are risking 1 to potentially gain 3. Now, once again, this way of trading is not wrong, but the win rate is very poor, and you will not be satisfied with a low win rate like that. That's why we focus on the actual price, where price is going to go next. We're not trying to time the market all the way at the bottom of this wick and then figuring out with some random calculation or indicator when to sell, when to buy. No, we only care about where price is going to go next. In this case, it was this high. So we could have literally taken a trade anywhere in here. It doesn't matter. As long as this high did not get violated, you could have taken a trade to the upside. And as mentioned previously, I also want to talk about price gaps. Now, price gaps are essentially the same as fair value gaps, but they have different properties to look out for. Now, as you can see, this is a regular FVG that we have just talked about the last 10 minutes. But this one is an actual price gap. As you can see, how can you spot a price gap to begin with? As you can see, of candle number 1 compared to candle number 2, the closing price did leave a gap. Do you see this white blank space that you have between this and this candle? Between number 1 and number 2, there's a little gap in here where price did not reach into. It reached into it at one point, right? With a wick onto the upside. But it never reached into it with a body closure, creating an actual price gap. Now, the price gaps, the reasoning for that is not as important, but for everyone who wants to know why. Basically, there was not enough liquidity to sustain the price at that current moment, which resulted in an entire gap price. Okay, but why do they matter? Why is it so important to us? Similar to fair value gaps, most of the time they get traded back into. As you can see, we did trade back into it. Now you might say, okay, well, where is this different from FVGs? The difference here is, we have talked about previously, that the FVGs, they get traded into at some point. It doesn't have to be immediately, guys. At some point, they get traded into, but sometimes just with a wick and then the distribution lower or higher depending on the direction. But for actual price gaps, if we extend those two lines from left all the way to the right, usually, not all of the time, but usually price gaps always get filled with body closures, right? This is the entire body of the candle for everybody who doesn't know, and this is the wick that I've been referring back to. They get traded into with the bodies into that gap. So that means as long as we did not trade back into it with bodies, so everything like that, right? We just trade into it with wicks. You could have taken a trade onto the upside just from knowing that simple and easy way of trading. Okay, and since you have made it this far into the video, you might as well like the video and subscribe to the channel, and make sure to turn off the notification bell so you don't miss any future videos. If you want to have free live trades, free education, and I'm also going to break down your own trades, then join my free Discord. The link is in the description down below. See you guys in the next video. You have made it this far into the video, and let me be very clear about this one. You can go two paths in trading. Either you're taking the path that I had to take, which led me to countless of profit challenges being blown, and also personal accounts that I have lost. The list goes on. Or you can also take the shortcut, being mentored by somebody who has 5 years of experience, more than 500k in total funding, and also multiple prop firms. Now, I have been interviewed by prop firms where I basically explain how I've gotten to all of those payouts. When you're trading for this long, your win rate is extremely high. That is why we barely get into any kind of drawdown. Now, and this is not just a regular mentorship, you will get access to everything I have learned over the past 5 years of experience. So if you want to learn how to get the same results, it's the first link in the description.